Thank you very much. It's very heartening to see so many people here from so far away, so many countries. I was the founder and owner of a company based out of Scandinavia called DigitalBridge, and in the first year, second year, fifth year, there was nobody out there in the audience as we were explaining what is the concept. And so here we find ourselves today. Each of our panelists are going to introduce themselves in just a second, and where we find ourselves today reminds me of all the fairy tales you heard when you were young. Once upon a time. Once upon a time pre-internet. Once upon a time pre-this. Once upon a time pre-that. And yet, here we are today, and someday you will be telling your grandchildren or your children, once upon a time. So, Robin, may we go down one after another? Please introduce yourself, a little bit about your background and your company, and we'll go on to the next one.
Hi, good morning. Good to be here. Beautiful weather in London. I'm Robin Khuda, founder and CEO at AirTrunk. AirTrunk is a hyperscale data center operator across Asia-Pacific region. I started the business in 2015 and built the first hyperscale facility in Asia, in Sydney. We now operate 12 facilities with just over 2 gigawatt of capacities. Thank you.
Hi everyone, I'm Manjari Govada. I'm a managing director at DigitalBridge, and I head up our investment strategy here in EMEA. DigitalBridge is a digital infrastructure investment firm. For us, the 4 key verticals we focus on are data centers, towers, fiber, and small cells, and really excited to be here to speak to you all today.
Thanks everyone for coming. Thanks, Joe, for having me back at this conference. It's great to be here. My name is Joe Harar. I'm CFO of EdgeConneX. I've been involved with the company since we founded it in 2009. We are the owner, developer, and operator of over 80 data centers across the Americas, Europe, India, and Asia.
Great. Hi, my name's Matt Ahern. I'm the head of digital infrastructure at Blue Owl Capital, a $275 billion alternative asset manager. Prior to Blue Owl, I was a founder and managing partner at IPI Partners, the predecessor firm that Blue Owl acquired. We've invested across the digital infrastructure sector, especially through platforms like Stack Infrastructure, Beal Infrastructure, DF&I, et cetera, and we're an investor in the Stargate project in the United States. So thank you for having me.
And thank you guys for joining us from all over. There were an awful lot of early morning flights this morning. Thank you, Joe, for fighting the traffic to come in from far and wide. As I read the press, as you read the press, it seems like this is the gold rush. The capital markets are wide open, the demand is unlimited, the customers are there, the power is there. Well, maybe the power is not always there, but it seems as though everything is on the up and up. And when I read it, and coming from the 2000 when it started, it has a little bit of a surreal effect to it. And I want to start with one of our most understated speakers here, Joe. Is it really that bullish out there? Are you as bullish as all the press makes it out to be? Is the AI hype for real? Tell us.
Yeah, Byrne, thanks. So I think maybe tackle this from 2 different perspectives. Tackle it from thinking about how the AI hype is actually impacting digital infrastructure and the 4 walls that we build in data centers, which is what I spend every day doing, and then maybe talk a little bit about the hype of the actual utility and application of artificial intelligence that lives within the 4 walls. I think from a data center demand perspective, the AI hype is real. When I look at, for EdgeConneX, using us as an example, we had our largest year in 2024 by far in terms of sales, and approximately 25% of the capacity that we leased last year was AI driven. When I look at this year, we will more than double what we accomplished last year, and approximately 50%, based on my current estimate, of over a gigawatt's worth of leasing will be AI-driven. And so from that perspective, there is hype, is real, and we are installing hundreds of megawatts every single month to support it within the EdgeConneX platform. Let's talk for a second about the utility and the application of artificial intelligence. I think in some ways the hype is real, and while we as a business are long-term believers in what AI, how transformative AI will be, there are some aspects where the hype is not really achieving what is possible yet. So when you look at how AI is impacting our lives, you see real-world applications in ChatGPT, in coding tools, in image creators. We see business analytics taking off. We see those are real-world applications. One aspect which I'm most excited about, where there are medical diagnostics that are starting to drive patient outcomes. That stuff is happening, and that stuff is exciting, and that is the potential of AI. 25% of all new code at Google today is being created using AI. It's an amazing opportunity for us, and I think we're really in the early phases, because when you compare Google, you see that only 2 or 3% of all of the activity that us as business owners are doing are leveraging AI. So we're still very early on, and the adoption is probably slower than we would like. And so maybe just spend one more second on what is not gotten the traction in terms of AI. AI, while is really good at understanding patterns today, but it's still that human intelligence and the human emotion, we haven't been able to figure out how to recreate that. We look at things like autonomous systems that we thought AI was going to have this really immediate impact, you know, robots and driverless cars. I mean, and that stuff is taking a lot longer to gain traction. As a byproduct of that, revenue is slower than we would have liked or probably anticipated, and probably one of the things we'll talk about today is the volatility in the data center market and the demand profile as a byproduct of that revenue taking longer.
Thank you very much. Robin, you come at this from geographically a different perspective, and sometimes the wave takes longer to get to farther out from Silicon Valley, for example. Are you seeing many of the same trends, or what differences?
Yeah, look, I agree with what Joe said. You know, we're seeing there is from demand point of view, data center demand point of view in Asia. We're seeing very large demand for deploying for AI capacity. Just adding to Joe's point, if you think about AI, it's basically transformational. So it's going to transform everything we do. If you look at globally, the productivity is down. Many countries, aging population, places like Europe, Japan, you know, there's the aging population, etc. So you're going to need automation. So you can't sort of be productive without automation. So there is a lot of application of AI. But like any technologies, we're going to see volatility like next few months. I know there is a lot of media coverage about AI, demand, not demand, etc. But if you look at you know, the broader picture, like, you know, if you take 5 years view, no doubt, you know, AI would be a huge contributor to the data center capacities. So I remember when first cloud came in, feels like makes me feel older. 2010, you know, I was building, you know, 2015 100 megawatt site in Sydney, and like everyone would say, look, how are you going to fill up these facilities? And it took good few years. Like, you know, once you have enough use cases, different business, healthcare, education, every industry, agriculture, etc. I think we're going to see very quick adoption of AI and sort of the much larger demand for compute power.
Okay. Matt, a lot of optimism lot of demand, a lot of everything, as we just heard. Two questions. In the big picture, what is different now than a year ago? And secondly, what keeps you awake at night if it's all so rosy?
Yeah, look, it's a great question, Byrne, and if we compare it to where we are now versus a year ago, I would say a year ago it was unbridled optimism about what AI promised, and the amount of capital that was interested in the sector, chasing the sector, was massive. It was almost like you could fall out of bed and make money investing in the sector and AI. And then to Joe's point on some of the perhaps slowing of activity, the transition to there's $350 billion of CapEx being invested by hyperscale companies. Now we're in the phase of needing to produce return on that. We're seeing, I think, people come to a better realization that, no, this is hard. It is very hard to build data centers, to operate data centers, to find power, not just power, but actually to get entitlements. So I think some of that has changed where maybe a year ago the industry, and it might be actually spoken to for AI, was almost priced to perfection. If you look at where NVIDIA's stock was, if you look at some other stocks, again, it was almost that you could fall out of bed and make money in it. So that's changed, I think, in a meaningful way, where people are coming to a better understanding of what the market dynamic is. To your question on, what keeps us up at night, what keeps me up at night, it still is some of the challenges associated with sites. It is power. We talk a lot about power, and it will be a common theme throughout the day. But that continues to be something that needs to be solved for, and it is a timing, a dynamic that does continue to get pushed out. Even if you're hearing from a utility, from power generation that, oh no, it'll be ready in 2027, 2028, it can very easily slip another year. And I think just overlaying on top of that as well is increased uncertainty in the market. We've seen it over the last few months, associated with tariffs, associated with other volatility in the market. Those are the things that when we are investing, when we're planning for really 3 years, 5 years, 15 years out, uncertainty right now makes it more difficult.
Manjari, there is lots of uncertainty, and yet the customers, once they have a signed contract, you may have found this, sometimes Google's not amused when you say, well, I've got a 6-month delay, and Microsoft says, stuff it. You either open or I exercise my termination clause. How is that dynamic going down with the volatility, with the trouble of power, et cetera? And then secondly, what about the traditional cloud, AI or not AI? How's that factoring in?
Great question. And, with all of the noise in the market in the last year that Matt alluded to, we see it as really an opportunity for the big players to step back for a moment and evaluate who they work with. We see this as a mop-up moment to say, okay, who are we going to pick as our champions in these markets? Because the scale of these deployments are getting to be so significant that the risk that the underlying customers are taking is just getting greater and greater. They're no longer hundreds of millions of dollar CapEx projects. These are multi-billion-dollar CapEx programs. And so who do you trust to deliver that for you on time, on schedule, on budget? And that challenge is only getting harder. And so as we think about our interactions and our portfolio company interactions with these customers, it's all about that transparency and that realistic timeline. And I think the difference between, more established players that have these long-standing relationships, if you tell a Google, this is the RFS date that we realistically think we can deliver, it's having that trust and relationship to know that that's a real timeline, and that the stakes of these are getting much higher too. So we again think of this as a shakeout moment where those that have the long-standing relationships, those that have that strategic conversation, they're able to differentiate themselves, and I think that's going to happen more and more going into the next few years.
Hard to be a startup.
It's not to say that there isn't room for startups, right? And that there's not room for more companies to come into this space. But I'd say the bar has been set a lot higher. The capital, the execution risk has been set a lot higher.
What keeps you awake at night? Business related.
All of this. The people, the power, the capital, the execution risk, right? That I go back to delivering on time, on budget, for all of our portfolio companies. When we talk in our board meetings now, it's no longer about raising 100 million of equity. We just had a board meeting yesterday and the numbers got thrown out again. I'm like, my goodness, we just finished raising for this business, and they're like, we could do another billion of equity if you gave it to us. And that is something that, if I park execution aside, because that's on our portfolio companies and it's us to manage, it's how do we deliver for our companies to be able to go deliver.
Okay, so let's talk about delivery and uncertainty. Robin, do you look at the geographies differently in terms of this is more volatile, this is producing the yields we said it was going to yield, this has proved to be incredibly difficult, and are you diverting capital or targeting capital towards the lower risk, higher return paradigm?
Yeah, look, I'm coming from sort of perspective in Asia. As you know, there is many countries in Asia. Each country is so different, like Singapore, so different. Doing business in Singapore, very different to doing business in Tokyo, doing business in Jakarta, etc. So that, I think the first thing is, we consider the geopolitical risk, and this is the top of the risk for our customers as well. And that drives, we decide like this is where we're going to deploy the capital. Then you sort of overlay execution risk as well, like can you find a good GC in this market or not? Can you find good operational people in a market or not? That's also important. And finally, the other thing important is for this project, as you know, you have to deploy hundreds of billions of dollars. What is the cost of funding? That's another big consideration as well. Because end of the day, look, I'm coming from operator point of view, this guy's investing. You have to make money, right? It's pure formula. This is your cost of capital, and this is your yield, and the delta. That's where we're developers basically. So all those things take into consideration for us to decide. Look, are you going to deploy capital in Malaysia versus Indonesia?
Yeah. And Joe, what about you are in some of the markets that have a longer track record with this in this industry? You're the guy that controls the spigot. Are you diverting here or there? Are you saying we ought to, everyone's competing for your internal capital, no?
Yeah, I think it's very similar for us as it always has been, where we've been very focused on markets where we can generate outsized yields. It's just the scale of what we are doing now is so much greater, true for all of us, right? Average project is 100 megawatts, $1 billion. Just to pick on your example, you say, all right, well, if I'm 6 months delayed, that's $40 million in interest expense that I have to be able to absorb, not an inconsequential amount of money. So when we're thinking about markets, very focused on certainty of delivery. That's both in existing markets where we have experience, but also the work that we are all doing on the front end to try to de-risk those markets that we're more opportunistic in has gotten much greater. And we're much more diligent, both with respect to the regulatory component of it, the power component, the customer component of it. And so, but that's not necessarily slowing us down. I think it's just the business that we are in is evolving from a risk perspective as a byproduct of the volume, the size, and the magnitude of what we're developing.
Okay, so we will be taking questions at the end if you guys want to think about that as we go along. Let's get into some of the obstacles to delivery, the things that are getting in the way. It's already been mentioned that power. In real estate, it used to be location. And so it's all about power, Matt. And there's a lot of scarcity. How are we getting around that? And going back to Manjari's comments with the customer, how are you guys bringing the customer along? Or are they helping scout for you? Say, I see where there's power.
Sure. Yeah, I think it's a combination of all of the above, quite frankly, and maybe an unsatisfying answer. It's really working not just with utilities and markets, but I would say It's every stakeholder that might be in that market. It could go from working with county commissioners, it's working, to use the US as an example, working with the state, working with the federal government, working with utilities, working with power companies. It's that total engagement that's really necessary here. You can't have just one piece of it because you might be missing the neighbors who are dealing with NIMBYism. So I think we've found that if you have that level of engagement, that's when you're putting yourself at a higher probability of succeeding. You know, Joe referenced being in the markets where, to some extent, you have experience because you have that ground game. I think gone are the days, I'll pick Northern Virginia just because it's the largest market in the world, gone are the days of buying a nice rectangular piece of dirt and saying, I will have power because the utility has to provide me power. That's what they do. That's true, but it could be an extended period of time. So, you know, going into markets that you have some level of understanding, I think is very important. You can get burned very quickly if you're just jumping into a market and don't have that overall ground game. But I think it is, to a point you made, I think that is pairing it with a very strong understanding of the demand in the market. How are the end users thinking about it? How do they view their own configuration of sites? Again, it's important to understand that dynamic so you know what the demand is. Again, you can get very burned, even going into a market that you think have power, that you think has that rectangular piece of dirt, and you can have challenges associated with it. I think one thing also to keep in mind when you are going and trying to pair supply and demand, Joe referenced it and you alluded to it, Byrne. We do talk a lot about AI here, and it is a huge market driver, but I think we overlook to some extent cloud and the massive demand associated with cloud. I think Joe threw out a few numbers of 50%, I think, being AI. Well, that still means 50% is cloud, and still fundamental is, and this is what's changed, I think, over the last year, you have to remember that fundamentally cloud is still a massive driver and one of our biggest demand drivers. So while AI is great, and I know the vast majority of this conversation will be talking about AI, we like to view it as the wave on top of a wave.
Right.
So when you're looking at sites, when you're looking at planning, to not underestimate the demand on the cloud side as well.
And sometimes a scarcity will be the mother of invention, Manjari. So if power is so difficult, where is it prompting innovation? Are there other solutions coming to the fore, whether geographic or power sources or otherwise?
Yeah, I mean, I believe that we're in the middle of a paradigm shift on power. Dominion just came out in Northern Virginia saying that there's going to be conversations now about minimum take-or-pay contracts for energy, 14-year contracts. And if a customer says, you know, I think it's data centers above 25 megawatts, if a data center says we are going to need this power, Dominion saying then you're going to have to pay for it. And that is a new normal that I think we're about to see in many other power-constrained markets in the world. We were sort of one of the market leaders with Vantage in Europe moving customers into Berlin because there just wasn't that much capacity left in Frankfurt. And that was a concentrated effort with the customer to say, let us build a 3AZ region for you. We believe we can be a long-term solution for you. In the same way, we have a significant capacity in Newport, Wales, where it's less than 1.5 millisecond to get back to Slough. For folks, that's actually quite an interesting deployment, and the power that you get in Wales is cheaper than anywhere else in the UK. It's green, it's hydro, and so there's element of that kind of capacity that's available that is still differentiated, unique, that doesn't require a massive shift in thinking. So we think that's an opportunity, but that being said, going back to Matt's point, all of our demand is customer-led. All of our investment is underpinned by customer contracts.
But are the customers more flexible about location?
They have
They
to.
never thought of Wales before, so they have to be.
That's exactly right. And so we expect more of that, and we want to be prepared for those sort of opportunities. But at the same time, there's a lot of, I'd say, good old-fashioned cloud, good old-fashioned core deployments in key markets like Slough, like Frankfurt.
So, Joe, are you seeing part of the innovation with the power problem, new sources of power? Is nuclear on the table, or some of the other ones on the table that haven't been? And that'll bring us to sustainability. So I'm going to drop that in your lap at the same time and say, are people still focused on sustainability, or just give me the goddamn power, don't talk to me about sustainability?
A lot of questions there, Byrne.
You're the man for the job, Joe.
Let me tackle them again one at a time. So, yes, power and near-term power is still king today. And frankly, I think that will remain the case for the foreseeable future, just given our expectations around demand. Whether we like it or not, it is the certainty of power within 12 months that will, and the ability to deliver that and fund that power in a fulsome solution that wins the day. So that, stepping back from sustainability, from nuclear, different sources of power, it doesn't matter necessarily what kind of power for some people, but that remains the priority in just about every single market around the world. That doesn't mean that that sustainability is not ultimately a critical goal of ours and all of our customers. And so when we look at our roadmap, we have milestones that we have to achieve in connection with each one of our key customers, and we map to that on a quarterly basis. And we audit that and we report out on it, and it is a distinguishing characteristic for each one of our businesses that we're all very focused on. So that is a 5-year outlook, though, and that is not a next 12-month outlook, and it's something that we have to be responsible for as operators. Maybe one last thing in terms of innovation, and I don't know if this is innovation, but one of the things that's unique about this group up here is that the businesses we fund are funded by the biggest balance sheets in the world, the largest institutional investors, the largest sources of capital, and that is what's enabling us to drive, I don't know, again, if it's innovation, but when we think about how do you get 12 months, how do you deliver in 12 months, how do you make sure that you are looking at all different sources of energy, and that's the capital component of it. It's allowed us to rethink how we utilize that capital and where in the supply chain we are investing. So probably what's changed in the last 12 months is, maybe 18 months, is we're taking a lot more inventory on balance sheet to allow us to deliver and to allow us to obtain that level of certainty. That could be anything from transformers to chillers, but ensuring that we have the slots, we have the investments that's going into it is one of the things that's, again, I don't know if it's innovative, but it's capital, and it's creating slightly different ways in terms of how we're investing to deliver what those priorities are.
So it's a shift of risk to a certain extent. In order to achieve speed to market, you're putting on the balance sheet those long-term items that you're going to tick the boxes because there's so much demand, and then you can compete. Something along those lines?
We think, yeah, I think that's probably true, although we're comfortable enough with the levels of inventory that we're taking on that they can be shifted. So,
Yeah.
you know, if Robin's got a project in Sydney and Melbourne, he's probably utilizing the same transformer. And so he's got the ability to shift the type of infrastructure. And having the flexibility to do those sort of things at scale is what's going to continue to differentiate providers.
Yeah, and I'd maybe take a follow-on point to what Joe just said. I actually don't necessarily view it as taking on more risk. I think it actually is reducing some of your risk when you're looking at the pace of deployment that you have. To Joe's point, I think there's not many people who can take on that amount of scale of capital because there is forward buying, there is forward commit, but it allows you to smooth out what the risk might be on development for delays for substations being built, delays on generators. So I think it actually can reduce the risk if you're willing to make the investment to do so.
So, Robin, with all this innovative approach to delivery or responsiveness to delivery within 12 months, et cetera. How has the financing market changed over the last 12, 15, 18 months from what it was? And are you seeing new types of financing emerging?
Yeah, look, of course, customer wants capacity yesterday, so I don't think that has changed last 10 years. What really changed is the volume, the scale, right? 100 megawatt site, there's $1 billion investment, so it's a huge investment, and of course, we typically go to the traditional bank, finance those deals. Once you get to a certain point, they get capped out as well. Everyone has concentration risk, et cetera as well. So, we already seeing there is a strong appetite from different sources, private credit, asset-based securities, securitization, all those different mechanisms, et cetera as well. But I think the other thing, what sort of we have noticed is, I think there is a better appreciation of the asset class of data center is. Like, I remember 2016 when I first signed hyperscale customer, it was very difficult to get a normal debt from a lot of the banks. Now, all those banks are financing those projects because the data center is as critical as toll road or as critical as hospital, etc. So there is a changes of shift on risk appetite from financiers. So again, look, I think as the industry grows, the more capital opens up as well. There is a lot of, if you look at some of the countries, they have a massive system of pension funds, for example. They typically, wouldn't invest in sectors like data centers. Now is, you can see data center, it's quite interesting sector because it has technology, it has very strong AAA rated customer contract, it has a growth component as well. So there is a better appreciation, and that's opening up new pool of capital. So I think we're going to see more and more creative financing. It's not just traditional financing, but all those other different sorts of financing.
And Manjari, are you engaged in any of those new types of, whether it's securitization, private credit, others? All of the above?
All of them. I mean,
And-
we were the first to do a data center securitization with Vantage now about 6 years ago in the US. We're now leading the way on data center securitizations here in Europe, and it's just deepening that pool of capital. Just last year, we placed $20 billion of debt across all of our different portfolio companies, and that was primarily data center led. If I think about that challenge of needing to do that level of debt placement, just us, by the way, there's you multiply that by the number of players in the market, that scale is quite significant, so you need to deepen that pool. The other benefit as these projects are getting bigger is you can actually slice up the financing even more, right? So across the full journey of a data center, it's now land bank financing, then construction financing. Once it's stabilized, you're going into the ABS market. But by the way, you can also add a holdco private credit note across the top to just optimize across all of the different assets. So this is necessary for us to deepen that pool.
The last comment about the quantum to which you're referring, I do think back to the first 15 years when I was growing Digiplex. I had a key partner with me, a gentleman named Bill Conway, co-founder of the Carlyle Group, and he was my partner personally, not with Carlyle. And we decided the quickest, fastest way to market was 100% equity. And that meant the sites, the design, the build, the open, and it was all equity. Nice to have a billionaire as your partner. Keeps things simple. And then we would go to the bond markets in that case. Not today. Not happening, not even for Bill Conway.
And if I can add on to that
Yeah.
too, right? When we talk about geography, the next question for us that we end up thinking a lot about is, okay, you spend $1 billion building this project in a certain location. Now you need someone to come and pay you $2 billion to buy that so we can return capital to our investors. And so when we think about how we pick and choose where we go, it's not just about us as owners, it's about the next buyer and how we generate attractive returns for our investors. And that means we are going to really sort of aim and fire where we think we have great exit opportunities.
Well, thank you for the tee up. So the question is, what are those exit opportunities? Now the money, Joe said earlier, the largest institutions in the world are in this game, and they're putting together huge packets of capital. And everybody in the game is putting together huge packets of capital. So at what point does this get so goddamn big that the exit is, you got to think that through from day one, sort of. Any thoughts, any of you?
I'll start. I think what Robin said about the classification of data centers as truly infrastructure is what will enable the various exits that the more successful companies are able to achieve. Coming out of COVID, the aperture of institutional investors that reallocated their capital from traditional commercial real estate into digital is just rapidly accelerated. And so I, first of all, believe you'll start to see institutional investment coming in to buy stabilized assets. I believe that you will see IPOs. I believe that this will start to look like a traditional industrial commercial real estate category over time, which will free up a bunch of different sources of capital to create liquidity for all of these businesses.
Yeah, I'm happy to jump in and add to it, and I want to hear Robin's perspective as well, given his transaction. But I do agree with Joe. I think it's all of the above to some extent is the answer. There's not necessarily a magic bullet in terms of, hey, all of these companies are going to go public because it's the largest pool of capital in the world and it makes sense to tap into it. I think we will see some of that. It's going to be situation specific. Byrne, you bring up a good point. Some of these companies are getting so large, it might make it more difficult to see massive M&A. M&A also typically stems from some benefit of synergies of putting businesses together, geographic expansion. I think we will see that, but I don't think it's necessary. Consolidation in the sector, I think, will be more driven by if there is a benefit of putting these together, not necessarily out of a necessity, because so many of these businesses are large enough to access the public market if you need to. So I think what you'll see more is some combination, depending upon the asset, depending upon the geography, on what those exit opportunities might be. You hear about things like yield cos, or very specific public market exits. I think the answer is all of the above.
Okay, we're going to come to questions in just a minute. Last topic. I'm going to tell you the topic I'm going to throw out for the moment, which was the wild card, Mr. Trump and the volatility. So we just bury that one for the moment. The last topic is the people. We've talked about capital, AI, engineering, supply chains. We talked about, what about the people? And how much does it matter? As long as you have some version of a profit participation program, is that enough? Is everybody hungry enough? That'll keep your retainage of key talent? Or is the famous aphorism, culture eats strategy for lunch every time? Is that appropriate here? And so I'm going to ask for a volunteer. Do any of you, yes?
Look, I think, firstly, the data center sector is still fairly new, so there isn't enough people had necessary experience, past experience, as the sector is growing. I think what sort of industry needs is how we can create the pool of new talent. I think that's going to be the big focus for all of us, because if you don't feed the pipeline, you're not going to have the talent. Of course, for this sector, when I started AirTrunk, always said, look, there is two things. The most important is the people and the customers, because you need people to execute to these big projects. And when you're operating at in an environment as hyperscalers, you're really servicing 4 or 5 customers. So it's not less about sales, it's more about execution. So people is super important. So from AirTrunk, look, some of the stats, like, we had since started 2015, we had 93% retention rate of our staff. It's not just all about the money, it's about how you can create the right culture, empower them, and so that they can execute. So the culture is super important. Of course, you also need to pay them, compensate them well. They go hands on hands.
Yeah.
Yeah, if I can add to that, the industry as a whole in the shape that it currently exists in is still so new, right? It's about 10 years old, if you want to even stretch that limit. And so the pool of talent is still relatively small, and you end up going to the same people over and over again that are potentially available. And I'm looking at this, especially from a leadership perspective for our companies. There's also lots of really good talent that are currently 5 years in, 6 years into their management incentive plan that are in too deep. And so it's how do you get exits in the industry to allow people to then move around. And so I'm hopeful that we'll see more of that movement in the coming years.
Okay, thank you very much. Thank you to the panelists. Are there any questions here? And how have we set ourselves up? Do we need a traveling microphone or? Yes, in the middle? That's you. Yep.
How do you see the business changing if everything gets more commoditized? We see larger amounts of energy on one side, and we see everything gets more standardized maybe, especially in the AI. So how do you see the business evolving in that sense, rather being an energy provider, or on the other hand, I don't know.
Anyone?
Yeah, look, I think it touched the topic about energy, and I think there was a bit of discussion about innovation, etc. A lot of our discussion with utility companies, because we're asking for large amount of power, etc. Data center is actually part of the solution. It's not just the pure off-taker, part of the grid solution. So that's the way you need to look at it, because data center can provide with very stable load, which, when utility companies investing billions of dollars capital, they need to get the return, so they need minimum base load. So you need to change the narrative. So you need to work with utility companies. Look, we're not just pure off-taker. We are part of your solution. We are already seeing some of the innovation happening, some of the utilities, we're doing flexible connection, for example. It's unlocked more capacities from the grid. Also a solution like battery energy storage solution as well. We're happy to, as an operator, we're happy to invest so that it can provide a base load to the utility companies. Hopefully that answers your question.
Yeah, I'll jump in. I mean, we built EdgeConneX with a thesis around standardization. The first 25 data centers we built had a similar mechanical electrical one line, and that was part of what we were trying to transform was standardization. Unfortunately, no one data center is that standard. We're working on natural gas, we're working on grid, we're working on hybrid, we're working on nuclear, all of this stuff, and it's very state and local regulatory governed, and it's just, there's each project remains so unique, and we together are working to standardize it, but just as I look over the next 5 to 10 years, nothing is going to be standard, and so that risk really doesn't keep me up at night.
The whole industry is a result of innovation, and it's going to continue. Other questions? Yes.
Thank you. Is there a risk, just following up from this commoditization question, is there a risk that fundamentally the wrong type of capacity has been built? Because it strikes me that the private equity-backed operators have run to add an immense amount of capacity based on power and land, forgetting what Byrne alluded to, which was, okay, not location, but connectivity. I think there was one mention of connectivity and latency in this entire discussion, which was around financial services. The horrible realization that I think is going on at the big private equity firms is that AI is fundamentally very latency sensitive. You know, Joe, you mentioned image creation, video creation. These are very latency sensitive services. It strikes me that 90% of what's being delivered by QTS and others is simply not fit for purpose when it comes to delivering the right kind of latency for these applications.
Anyone want to handle that one?
Yeah, I'm happy to start out with it, and it's a good question. Look, I think you have to kind of start to bifurcate things by workload and the demand side of it. If we look at AI, we'll just use that component. There's, to some extent, two different problems it's trying to solve. There's the training aspect, and then there's inferencing and various flavors in between. I think as you look at training, those are going to be, to some extent, in specific geographic areas where it's more availability of power, perhaps lower cost of power, less latency focused on those, but massive sites. And then if you look at the inferencing side, which is really the revenue side of AI, inferencing to some extent, where I think about where we are today, it's still in its infancy, and it's almost similar to a few years ago with, I'll use Netflix as an example. Right? Netflix a few years ago, you'd let the little wheel spin for a while and you'd be fine with it. Now, if on Netflix it doesn't actually start instantaneously, you're upset. And I think that's where we are inferencing related. And so when you think about inferencing markets, those tend to be more traditional cloud markets. So you have some flexibility associated with, is it cloud? Is it going to be inferencing? Is it a combination of both? I think what it causes you to need to do is to underwrite your investments in different ways. There's different risks associated. You need to really understand what the use case associated with it is. But I don't think, going back to the things I worry about at night, the technology associated with what's being built, where it's being built, is not very high on the list. I can use an example of one of our data centers we own. It is a 25-year-old data center in Virginia. It used to be the original AOL data center. It's still fully leased. It's still a great data center. So the fact you have capacity, the fact you have power there, I don't think there's the risk around technology that maybe be perceived by the market today.
Other questions? We've got time for a few more. Yes.
On the basis of supply and demand, obviously the cost to build is going up dramatically, I would think. Particularly the cost of land with power. I just wondered if you've noticed that increasing as a proportion of the overall cost of the build.
Yes, certainly. I mean, land prices have materially increased. The minute it starts looking like data center land, right, that's taken on a whole nother layer of cost. Joe alluded to bringing inventory onto your balance sheet earlier. There's a cost associated with that, right? We're using our equity, our balance sheet to help support that. And so as far as the customers are concerned, we're helping them with off-balance sheet financing as one of the ways that we think about it. And so it's having that open dialogue with customers of, here's the real cost of what it's going to take to deliver the solution for you. What has been positive, though, is it seems like the conversations we're having, they're very understanding and receptive, because oftentimes they also have their own self-build teams that are seeing similar cost increases, and so they have their own internal benchmark that they're marking us against, which is helping us in these conversations, because ultimately they need us to be financially successful to keep this industry going.
Okay, one more. Yes.
Hi, is that working? Hi, it's a request that you come to the panel at 11:30, because I'd quite like a tiny weeny bit of each of your budget to actually solve this computing problem, probably about 4 or 5 years faster than is actually happening, and you get better returns. So please come to 11:30.
There we go.
Fair enough.
Thanks, Marky. Any last ones? So, panelists, for anyone who'd like a final statement, 1-2 minutes. What's your counsel to our colleagues here?
I think you mentioned about, there's two important topic with the data center is you asked about the risk and what keeps Matt and everyone else's work. To me, it's the regulation. I think that's going to play a key part going forward. Like, of course, data center takes up a lot of power, a lot of water as well. And I think we're already seeing a lot of the government coming up with not so practical or bad policies. I think that's one of the things we need to keep an eye on it, how we can educate government and demonstrate data center adding value. And correlate to this is, I think, the social license to operate. That's going to be very, very important for success because there are going to be a lot of scrutiny about water usage, energy usage, carbon footprint, etc. And communities will have a bigger part. They're going to decide who's going to build the data center in that council. So those are the two things, the regulation and social license to operate. I think we're going to see there is a lot of discussion over the years.
We could talk about this for days, and so it's a dangerous giving me that. But a topic that we didn't spend too much time talking about that I think is really interesting and we'll see play out more, particularly as an American in Europe, is I think data sovereignty, this idea of what information is being used to train AI, that's about to take on a greater dimension, we believe in. So I think there's a really interesting vertical to explore in that kind of private cloud perspective. But, if I take a big step back, I think we're really quite excited about all of the movements that we're seeing in the AI space, and we're very optimistic about what this means for our investments right now.
That's great. I think we are in a period of transition, like Robin talks about, where there are mounting challenges, regulatory hurdles, power supply shortages, all the things we've talked about, sustainability, expectations, and that's coming at a time where demand for the product that we're developing is growing faster and faster every single day. That's an interesting conundrum. I think the thing that we think about is to address that challenge is diversification. That's diversification of your geographies, your tenants, your tenant workloads, your currencies. All of those things we think are sort of core to our strategy and core to what will enable us to work through a lot of the mounting challenges which will prevail on a market-by-market basis.
Yeah, it's hard to go last because I like a lot of their comments. I guess the advice I would give is be skeptical of sites. If it looks too good to be true, it probably is too good to be true. There's a lot of groups that are out in the market, referenced perhaps a little bit with one of the previous questions, that to some extent, using an oil and gas term, people are wildcatting to some extent in the market that maybe don't have the balance sheet to play fully at the data center build level, and so instead are trying to go out and find sites, lock up sites, and then create almost an artificial amount of demand in a market for power. We hear from utilities that there might be people looking for capacity on the same site, multiple people looking for capacity on the same site. So I would just encourage people to be skeptical because it is very hard to find sites. It's very hard to find power for those sites when the power size is getting much larger and larger, and it's very hard to bring it together with all the various stakeholders. So be skeptical as you see something that looks too good to be true.
Thank you. Once upon a time, this is the time, and you are in it. We did not discuss today the social ramifications, broadly writ, of what AI can do and what it can do in the wrong people's hands. That's another venue for that, but we're part of this, and we ought to be part of that conversation. Thank you guys very much. Thank our panelists very much for flying in from all over the place.